Welcome back to the channel. In today's video, we're going to talk about a simple yet powerful investment idea: how an investor can allocate $100,000 across three major US ETFs, each representing a different investment style. Don't worry if you don't have charts or visuals. This video is fully voiceover friendly, so you can understand everything just by listening. Let's get started. When investors think about building a diversified portfolio using ETFs, three names frequently come up in discussion: the Vanguard S&P 500 ETF, the Invesco QQQ Trust, and the Schwab US Dividend Equity ETF. These three funds each represent a different investment focus. One offers broad exposure to the overall US stock market, another leans heavily into growth and technology, and the third concentrates on dividend-paying companies that generate income. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the Vanguard S&P 500 ETF, commonly known by its ticker symbol VOO. This ETF is designed to track the S&P 500 index, which includes approximately 500 of the largest publicly traded companies in the United States. The structure is market cap weighted, meaning the largest companies in the index have the biggest influence on the fund's performance. As of recent data, this ETF manages assets exceeding roughly $860 billion, making it one of the largest and most widely used ETFs in the world. Over the past 12 months, VOO has delivered returns in the mid-teens range, around 14%, although actual performance can vary depending on market conditions. One of the biggest advantages of this ETF is its extremely low expense ratio, approximately 0.03%. That means investors pay only a small annual fee relative to the size of their investment, which can make a meaningful difference over long time horizons. In terms of holdings, VOO includes some of the most influential companies in the global economy. Among its top positions are major technology leaders such as Nvidia, Apple, Microsoft, Alphabet, Amazon, and Meta. Because the S&P 500 has become increasingly technology-driven over the past decade, the technology sector now represents roughly 35% of the ETF's total allocation. This makes VOO broadly diversified across industries, yet still meaningfully exposed to innovation and growth through its largest holdings. Now let's move to the second ETF, the Invesco QQQ Trust, better known simply as QQQ. This fund tracks the NASDAQ 100 index, which consists primarily of large, non-financial companies listed on the NASDAQ exchange. Compared to VOO, QQQ is much more concentrated in growth-oriented and technology-focused businesses. The assets under management for QQQ are substantial, around $402 billion. Over the last 12 months, the ETF has posted returns in the mid-teens as well, roughly 15%, although like any equity investment, performance fluctuates with the market. The expense ratio is higher than VOO's at about 0.18%, but still relatively competitive compared to many actively managed funds. When you look at its holdings, you'll notice overlap with VOO. Companies like Nvidia, Apple, Microsoft, Alphabet, and Amazon also rank among QQQ's largest positions. However, because QQQ holds only 100 companies and is tilted heavily toward growth sectors, its technology allocation exceeds 50%. This makes it more volatile, but also potentially more responsive during strong growth cycles driven by innovation, artificial intelligence, cloud computing, and digital transformation trends. In simple terms, while VOO offers broad exposure to the entire large-cap US market, QQQ magnifies the growth and technology component of that market. Investors who allocate a portion of their portfolio to QQQ are effectively increasing their emphasis on companies that tend to reinvest profits for expansion rather than distribute them as dividends. Now let's examine the third ETF, the Schwab US Dividend Equity ETF, known as SCHD. Unlike the previous two funds, SCHD focuses specifically on high-quality US companies that pay dividends. It tracks the Dow Jones US Dividend 100 Index and selects firms based on metrics such as dividend yield, financial strength, and consistency of payments. SCHD manages approximately $83 billion in assets. Over the past year, its share price growth has been in the low to mid-teens range, around 13%, while total return including dividends has been closer to 18%. The expense ratio is approximately 0.06%, which remains very competitive for a dividend-focused strategy. In terms of holdings, SCHD includes established companies such as Lockheed Martin, Texas Instruments, Chevron, Coca-Cola, and Home Depot. Compared to VOO and QQQ, its sector composition is notably different. Energy, consumer staples, and healthcare make up significant portions of the portfolio, while technology represents less than 10% of total allocation. This gives SCHD a distinct profile centered more on income stability and diversified sector exposure outside of heavy tech concentration. Another defining characteristic of SCHD is its dividend yield, which has been around 3.3%, along with a 5-year dividend growth rate near 10%. For investors who prioritize consistent income or want to balance out a growth-heavy portfolio, this ETF can serve a complementary role. So, how might an investor divide $100,000 among these three ETFs? One example allocation could be 40% to VUO, 30% to QQQ, and 30% to SCHD. In dollar terms, that would translate to $40,000 in broad market exposure, $30,000 in growth-focused NASDAQ exposure, and $30,000 in dividend-oriented equities. This structure attempts to balance long-term growth potential with income generation and diversification across sectors. Alternatively, a more conservative allocation might shift greater weight toward dividends and stability. For example, 60% in SCHD, 30% in VOO, and 10% in QQ. In this scenario, the majority of capital emphasizes income-producing companies while still maintaining exposure to broad market performance and a smaller slice of high-growth technology. It's important to understand that these allocations are simply examples. They are not guarantees of performance and not personalized financial advice. The appropriate mix depends on an investor's goals, time horizon, risk tolerance, and income needs. Younger investors with a long runway before retirement may lean more heavily into growth-oriented ETFs. Those seeking steady cash flow or lower volatility might emphasize dividend-focused funds. The Vanguard S&P 500 ETF provides diversified exposure to 500 leading U.S. companies with very low costs. The Invesco QQQ Trust concentrates on large-cap growth and technology companies, offering higher growth potential along with higher volatility. The Schwab U.S. Dividend Equity ETF focuses on financially strong dividend-paying firms that can provide income and sector diversification. Together, these three ETFs represent three distinct pillars of equity investing: broad market coverage, innovation-driven growth, and income-focused stability. By thoughtfully combining them, investors can create a portfolio that aligns with their financial objectives while maintaining diversification across sectors and investment styles. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.